Well, hello everyone. Welcome to After the Close. What a whirlwind. I don't know how to explain today. I think of a toilet flushing, which is maybe not the nicest way to describe what was happening in the market today, but there were a lot of things that seemed to be in a bit of a spin and downtrending. And if we look at our investments, how do we manage that and what do we do? And I want to start by saying, I want to applaud you for just showing up for any of these webcasts that we host, let alone one like this, because the temptation is so strong to stick our heads in the sand, to close our laptop and say, I don't know what to make of this, like it's just too painful to look. And so I'm not going to look. But I think that, there can be money in them, our hills, and we're going to look at ways that we can invest perhaps and take advantage of things that might still be looking strong. And you might say, hey, after a day like today, where would that be? And so that's what we're going to talk about. We're going to talk about, and I used this analogy earlier this week. How do you hug a porcupine? Very carefully. And so we're going to look at how we can tiptoe through the turmoil and tariffs that have characterized investing and trading so far this year, and tiptoe in a way that might work out in our favor. So I want to thank all of you who helped bring this class to life. So to Chris and Will and Riceberg and TM and Beth and Jay and Brown Buffalo and Marcus, like all these familiar names, Gary and Chuck, thank you for bringing this class to life. And we've got Mike Fairborn with us in the chat. So I encourage you to follow Mike on X. He's posting lots of great stuff, Mike Fairborn CS. And then of course, follow me as well, Barb Armstrong CS. It's another way for us to communicate with you outside of webcasts like this. Okay, know that the information that we use discussed today is for information purposes only and shouldn't be considered as a recommendation or endorsement. We are going to look at marrying a stock acquisition strategy with an option strategy today. So know that options carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform. It's a brilliant place to learn and hone your skills and make sure you understand your trading plan before you consider trading in a live account. Know that short options will never be assigned early in Paper Money. That can happen in a live account. So we're going to go out, have a look at what happened, post the tariff announcements after the market closed yesterday. And then we're going to discuss a strategy called a collar strategy. Now, I haven't been with you for a month, and it's just the way things have played out with my schedule. So the last time I was here was March 7th. And ironically, we placed the same type of trades that I'm going to suggest that we're going to look at today, as a way of investing in a risk-defined kind of conservative way. And that's called a collar strategy. So let's get out and have just a quick look at what happened in the markets. Now, I don't know what kind of time you have. This is called After the Close, and it's really designed to be for people who aren't able to, watch webcasts during the day, or for people who have a job and they can't be watching the markets throughout the day, and yet they want to be able to invest. And so, you may not be able to join the Trader Talks group at the Market Open with Kevin Horner, but if you can, or if you want to go back and watch those in the archive, they are really well done and give you a more in-depth perspective on what's happening in the markets, both here within the US and on a global basis. So here's our S&P 500 down almost 5% today. I mean, staggering. I mean, we were up over 20% in this index last year, and we have given back 12% as of the end of day today from the February 19th all-time high. You know, we gapped down and we kept on falling today. And this is a reaction to the tariff announcements yesterday. And the NASDAQ, I hate to say it, is even worse, you know, down almost 17%. But, you know, if you come out and look at, this is the Market Watch, the S&P 500, sea of red. And if you're not familiar with this, this is just the Market Watch heat map. And then I've picked the S&P 500. Technology, and this is the technology sector here, really got hammer smashed, didn't it? So let me grab my drawing tool and I'm going to change the color so we can see it. So here's our tech sector. You know, that was pretty brutal, right? Financials, dang, not much green there either. Consumer discretionary, clobbered. Look at Amazon, Tesla, and even the communications sector. We had T-Mobile, Verizon, and AT&T up, and I think we own at least 2 out of 3 of those in this example portfolio, which is, you know, kind of ironic. But where did we see kind of rays of light? And I would say that was in consumer staples and utilities primarily. And so if we wanted to look at where might money be flowing, these are areas where we might want to look. And it looked like there were some sectors of brightness or greenness, if you will, in that healthcare sector also. Energy, another one. Ugh. I don't see, there wasn't any green in there at all. Sea of red. Yeah. Okay. And you know, was the NASDAQ better? Well, let me just clear my NASDAQ. Yeah, no. Now, consumer staples, again, you know, consistently showing rays of light, but just a whole lot of pain. Okay. So what do we do when there's a whole lot of pain? Yeah, just let me have a quick look. Yeah, the phone companies. Yeah, somebody's saying, is it Christmas or like Valentine's Day? There's a book, you know, it's a children's book called The Day the Crayons Quit. I think it was called that. And I'm not recommending any particular book, but you know, one of the first to quit was the red crayon because it's so overused, right? And then there were other crayons that quit because they were never used, and they were feeling left out. So red crayon, a lot of use today. But let's come and look at our monitor tab because I want to talk about a strategy, and let's we'll look at McDonald's first. So Mickey D's, you know, was up today. And we are actually, you know, in the green on this position that we put on the 4th on the 7th. And so if you didn't watch this webcast, because it's after hours, so these trades go in on the day after we have this conversation, you can go back and look at this on the 6th. And I'll put a link into that in the show notes. But here on the 6th, we saw this kind of double bottom pattern, or like it you know, may not be the tidiest, you know, we're not going to put it in the in Investopedia, you know, as the perfect example of you know, a head and shoulders kind of pattern, inverted head and shoulders. But we kind of had this type of pattern, or a consolidating, you may want to call it double bottom kind of pattern. But we had this pattern and it broke out, and then it came back to retest, and then it came up, came back again. And when we put the trade on, we put it on this day, and then it filled on Friday morning. Okay. And it did end up coming back and retesting again. And the idea with this strategy is that we are buying a stock, but maybe we are concerned about tariffs or about, you know, whatever is on in the world. In March, I think our concern was tariffs. And so we said, hey, why don't we sell a covered call up here? And we ran the numbers and said, if we get called out, we've made a little bit of money and we're cool with that. But we want to protect ourselves to the downside just in case. So we bought the stock, we sold a call, and we got paid to sell that call. So we sold the call, and then the selling of that call helped us finance the purchasing of a protective put, which means we bought a put. Now, what does it mean when we buy a put? Well, when we buy a put, it gives us the right to sell the stock. At what price? At whatever strike you sold the call or the put, at whatever strike you bought the put at. So we bought the 300 strike. That means that, we have the right to sell our shares at 300. Okay. And the idea here is if the stock goes up and gets called out, we bought it at, I don't know, around maybe 310-ish. If we got called out at 320 and we got to keep this credit for this call that we sold and this expired worthless, we would still be pleased with that return. Now, was there an opportunity that we missed when I was off, and not conversing with you over the next 3 weeks? Do you see an opportunity that we might have missed in here? Because I see one, and here it is. We could have, had we been on our game, we could have, when we met the following week, so that was Thursday, Friday, Monday, Tuesday, Wednesday, Thursday. On this Thursday, had we met, we could have said, hey, we sold this call for 320. We might have been able to buy it back and said, hey, if this bounces, we still have our protection in place. And then when it goes up again, we can sell another call. And so we missed an opportunity to do perhaps a little bit of profit taking there. But, so I'm just pointing that out because we ended up not doing that. But we're now back up at 318.27. And this expires in 2 weeks. And so what might we do? We might say, well, this is kind of going according to plan, and yay us, because in a day when, the S&P was down 4.5%, this thing was up over 2%. And we're in a profitable position there. And so when we come and we look at this, we can see that this put that we sold, it's lost 50% of its value. We bought it for $237. It's worth $1.21 now, but we're okay with that. And we're going to leave that protection on, because who knows with these crazy markets what tomorrow will bring. And interestingly, this is at 320, our call, and it has lost a little bit of value. So we've actually made a little bit of money on that as well. So, we could, buy this call back and sell a call maybe out in May. So that's one way we could manage this. And so if we were doing that, how would we look at this? Well, we could come out to the trade tab and just say, hey, if I looked at the 320 call in May, what might I be paid for that? Or maybe I could even go out to the 325 call, given that it rallied so much today. We could receive, if we rolled that out to 325, and the bid-ask spreads are going to be wider because we're in the after hours. But if we roll that, we could end up making $5 more a share potentially and receive an additional credit. And so let's put that in as one example of a way to potentially manage this kind of caller strategy. So we're going to come to our monitor tab. We're going to come to this call, and we're going to create a rolling order. And what we're essentially doing is saying we want to buy back the call that we sold. And then we want to go out actually to the May monthly, and we're going to come out to 325. And so we're not getting as much of a credit, but if it goes through 325, we'd make $5 more per share. Okay. So we're going to put that in and tee that up to fill tomorrow. And when I'm in tomorrow, I'll leave this platform up so that I can make sure that this fills. Okay, so we're going to send that in, and this is that we have rolled the covered call to May and a $5 higher strike. Okay, so that's McDonald's. And what are we going to do with the put that we bought? Nothing. We're going to leave that the same. Okay, so that's McDonald's. Now, what about Hershey? Okay, so Hershey, we did the same thing. So if we come out and we look at the chart first, you know, I'm kind of a visual person, don't know about you, but when we look at Hershey, we can see that we sold this covered call way up here. You can guess what that's worth now. You know, dinquaqua, it's not worth very much. So maybe we could take advantage of that like we didn't do with McDonald's, and maybe we could buy that back and realize some of the gain on the covered call. Now, the protective put is where? It's in the money. So what does that mean? It means that it's trading below 170, which is we have the right to sell it at 170. It's trading at 166. Now, this doesn't expire for 2 weeks, so it could bounce back up above, and, you know, we could close it out. You know, we could, you know, end up buying it back. Now, right now, or sorry, we could end up selling it. If we sold it now, we'd make a profit, but then we have no coverage to the downside. And so we're going to wait, and we can talk about this one again next week. Okay. So, but what we are going to do is take the gain that we've made on the covered call. And so we're going to come here to the monitor tab. And when we look at Hershey, we sold that call for $3.70. It's worth 27 cents now. So we've got over 90% of our max gain. So we are going to create a closing order and say, you know what? I just want to buy that thing back. And let's see if we can buy it back for like 30 cents. And I'll look at this again in the morning, because at night, like I said, the bid-ask spreads are often, you know, quite a bit wider at night. And so here on this, we're looking to capitalize on the gain on the covered call. And then if this goes up, and this is, you know, another one that is in what sector? Well, if we come to the Analyze tab and come over to Fundamentals, it's in the staples sector. How about McDonald's? Well, this is interesting because it's considered to be consumer discretionary, but what do they sell? They sell Coke and burgers and fast food. Like, I don't know why you'd put Coke in the staples sector and then McDonald's in consumer discretionary, but yeah, I actually went to a McDonald's when I was flying, and you know, was in a hurry. Like, it was almost $20 for a meal. I was stunned. So that tells you how often I go. Like, I could have actually had real food. You know, I could have had a different type of dining experience, let me say, for that type of money. But, you know, in an airport, it is what it is. Yeah, so we are looking to recognize this gain, and then we will check back in on this one next Thursday. Okay. Okay. So that's our covered call and our protective put. Oh, sorry. It was Hershey on this one. So we're getting rid of this covered call. We're leaving the protective put in place so that if this continues to fall, we have, we know that we are in charge and we have the right to sell the stock for $170 a share. Now, if it goes up, and continues to go up, like McDonald's came down and then went back up again, could we sell another covered call? Yeah, we could. Yeah. Somebody said they put Budweiser in Staples. You see, I don't pick. They're not asking me. And I don't consider actually Coca-Cola a staple either. For me as a kid growing up, that was a treat. So Deere was the third one that we did. And we put this one on this day. And when we look back, was there logic behind our decision? When we look back, it's like, oh, were we missing something obvious? No, I think that was still sound. And until today, we would have been in okay shape. And so here's our protective put here. Here's our covered call. And can you imagine what this is worth? Yeah, not a whole lot. So maybe we do the same thing. We take our gain on the covered call and preserve our right to sell this stock at $4.50 if it continues to go down. Okay, so let's look at Deere. Where are we? We are down $1,800 on Deere. And you may say like, wow, that sucks. And yes, it does. But it could have been worse. Had we not put this protection in place, that, saved us, 13, 14, over $1,400 worth. So this loss would have been twice as much. And so we're going to come out here. And again, we sold our call for $7.90. At 79 cents, that we'd have 90% of our max gain. So we've got like, what, over 95%? All but a thimbleful is how I would describe that. And so we're going to see if we can get out on that one around 30 cents also. And again, this is one of those things that, like, if you're sitting there at 9 o'clock at night and you're looking at this, you might just want to check when the market opens. Just take a couple of minutes. And, if you can't download applications on your work computer, if you're at work, there's something called Thinkorswim Web that you could go into to manage these positions also, because it would just probably take you, 2 or 3 minutes. Okay. And so we are selling the covered call. Or sorry, we're buying it back. To realize that gain, to take it from an unrealized gain to a realized gain. Okay, so that's those. And I know we've spent a bunch of time managing these. I now want to look at some new opportunities. Okay, and it's interesting because remember, what happened with the markets today, down almost 5%, the S&P 500. But you had stocks like, and this section is sponsored by the letter K today, like KDP. So this is Dr. Pepper. And what section, well, I'm going to tell you. Here's how I found all of these. And, I created a watch list called Sectors Staples. And I don't want to kind of go through it. It takes like 2 seconds to create these, but I did create a little walkthrough on how to do this if you're not familiar with it. And if you subscribe to the Trader Talks channel, if you haven't, you'll want to click that button in the bottom right corner. But when you come up to playlists and then come down to the mini session series, because I get asked a lot, how did you come up with today's examples? So one, if you're new to technical analysis, I'm creating this series of very short videos on candlestick patterns. And once I get through the 18 or however many of those that I've got teed up, we'll go on to different price patterns. And these are all going to be 3 to 5 minutes long. But if we scroll down here to the turquoise section, these are all quick and dirty videos, like this one's 10 minutes long, how to create sector watch lists with scans. So, you know, I'll put this 5 to 10 minutes. Okay. I will put a link in here. And yeah, I'll put in a link to this watch list in the show notes as well at the end. Okay, to this trade management mini session series. Okay. So, you know, KDP seems to be kind of oblivious, doesn't it, to what was going on in the market today. Market down 5%. Yeah, this one up 1.3. And in fact, if we looked at the sectors, you know, this was the only sector in the green. So if I bring up, and this is a public watch list, sector indices, and we look at, you know, which was the biggest loser and which was the biggest winner, like the only one in the green today was consumer staples. That's the only one. Okay. So, and then if I come back to my personal, I haven't even done all of these yet, but I did staples in this section. Okay. So if we look at KDP, do we see something similar to what we saw setting up on the index overall, except that KDP is a little bit ahead in that we see this kind of inverted head and shoulders pattern, which is bullish. And then we saw it break out. Now we have earnings coming up and we still have all this tariff stuff. But one thing about soda or pop or whatever you call it is that even though this company may be global in posture, it's not like they make it all in, you know, one location and then they're shipping all this heavy stuff across the country or across the globe. Like if we come to the Analyze tab, we can see, you know, it's headquartered in Burlington, Massachusetts, but, you know, it has a global presence. And what happens is this stuff is manufactured in the countries in which it's sold. And so this might be a little more tariff averse. And one of the expressions I heard today was that, and it's the first time I've heard this. Now you guys may all be more savvy than I am and not have heard this, but they called it, there's been a lot of demand destruction. And what do I mean by that? It's like, in other words, people aren't buying stuff that they don't need, you know, or that they don't perceive they need. Like Restoration Hardware down 40% today. Nike took a huge hit, down 15% today. And it was like already on the struggle bus. Lululemon, ouch. So a lot of these consumer discretionary stocks getting hit and getting hit hard. But, you know, then we come back to staples and we have, you know, KDP, so Dr. Pepper, looking bullish and breaking out, and KHC, same, not quite the same pattern, but looking more bullish and certainly up over 2% today. That's Kraft Heinz, Coca-Cola, another beverage company. And again, so let's just step back a teensy bit here. Oh, I've got to, we'll look at a 9-month chart. So do you see what I see if we're playing I Spy with my little eye? I see a big fat cup and handle. So I'm going to activate this and drop this line down here. And, you know, you might say, well, it's maybe not symmetrical, but how many of us are really symmetrical? Like, might you also see that as an inverted cup and handle? Oh, yes, I do. Yeah. And you know, the way a technician might measure this, they might say, well, if this is about a $12 range, then I'd expect this to potentially go up maybe $12. But if we want to protect ourselves, we might do that. Could we do that collar kind of thing again? Yeah, we could. So I'm just showing you a couple of, examples. And then we had Kroger. Now we just placed a trade on Kroger in our technical analysis class on Tuesday, and we're feeling pretty smart about that today. But, one candle does not a trend make, but, this is a 9-month chart. This stock has gone from $50 a share to $70 a share, in the last 9 months. So, and it's up 15% year to date. So it's certainly beating all of the indexes, like, as in the Dow, the Russell, the S&P, and the NASDAQ. And you might say, well, it's up 5% today. Didn't we miss the boat? And well, we did miss an opportunity that, we may have taken advantage of in another account, and it was just an example. But could we say, well, hey, let's look at this. This has a PE ratio of 23. So we can come here and see that here. This is, so you see those scripts aren't always dead on, and we're not recommending them, but they're kind of handy to see on the charts. But here's our PE ratio of 19. So that kind of puts it in the value category. It's in the staples category, and it pays a dividend yield of 1.8%, even with the 5% rise today. So could we come out and sell? Let's look at May. If we came out and sold the 75, we'd make somewhere maybe just over 1% on that. And then if we wanted to protect ourselves to the downside, where might we put a stop? Well, we might say, hey, if it comes back below that 65 level, we'd like to be able to sell. So could we do the 75 and the 65? And so, we have a $5 upside and $5 to the downside. And so if we look at that, what we're looking at, and somebody said the other day, but I thought, why are you clicking buy when you're selling the call and buying the put? It's because in Thinkorswim speak, we are buying covered stock. So we're buying the stock, covering it by selling the call. But that's why, we're choosing buy. So our net price to get in is $69.79. Now, have we bought the put yet? No, we have not. So we're going to come to single order, first trigger sequence, and we're going to come over here to the buy, say, okay, we're willing to buy this put. Now, here it says 81. But here, well, this is the mid price for this up here, but the bid-ask spread is really wide because it's in the after hours. We could come here and make this 60 and then just check in the morning. Okay, so, but by doing a first trigger sequence, it's saying only buy this put, and we call this a married put, or this position altogether a collared position. So we are saying only buy the put if in fact we buy the stock and sell the covered call. So we're going to put this in our caller group. And you know what, at $70, we could do, we have $1 million account. So we could come back here and say, you know what, we could do a $25,000 position on this. What did we say? Our max position size was 50,000. So, if we're net paying about $70 to get in, if we took our 50,000 and we divide that by $70 a share, we could buy 700. Or you could buy one. I mean, you can do this however you like. Now, in class the other day, I forgot to adjust the puts, and somebody in the comments that watched it in the archives corrected me. So I went back and fixed it the next day. So that's a $48,000 position. Is that less than 50? Yes. And how much are we risking at $5 a share? We are now, and there's the one thing about a protective put is that we know that we have the right to sell it at 65. So if we're risking about $5 a share That's about 3,500. And so that's within our range of 1/3 to 0.5%. Okay. Yeah, so Wiley said, there are quite a few stocks in this category, and you're right, there are. So here's one with Kroger, and if this pulls back, are we going to be crying? No. But what might we do? Well, what we might choose to do is, if this pulls back to this 68-ish level, could we buy that call back and then sell another one when it bounces, or if it bounces? We could. And so let's keep ourselves open to that possibility. Okay, so that's that one. Shall we do another example? So we could look at Coke. And do you see a similar pattern here? This inverted head and shoulders and breaking out today. And we have earnings coming up. And when is earnings? April 29th. So if we go out to the May monthlies, are we protected over earnings? And we are. And, we've seen this stock, move down after earnings, and we've also seen it gap up. And could we end up called out? We could. But, if we look at this and say, if we end up called out and we've still made a profit, we're okay with that. We could always do it again. So if we looked at this 75 call, if we're paid $1.44 to $1.47 for that, and then where might we want our put to be? Maybe below the 72. So we could do this 70. So how much are we risking? About $3 a share. And we're looking again. Buying covered stock means we're buying 100 shares and then we're selling the call. And our price is 71.71. And then at this, was it 65? 70, no, it was 70. So if we buy, and we have to come down here to first and make this first trigger sequence, and then click on this buy. So all in, it's about 72.67. And if we get called out at 75, how much will we have made? Well, we'd have made, so let's say about 250. And this is just like ballparking, divided by 72.70. About 3.4%. And that may not be flying you to Tahiti and drinking something out of a coconut. It still beats a poke in the eye with a sharp stick, right? Especially considering the size of our account and how many of these might we do. This is a similar price to the last stock, about 7. And Firm and Sand, so that's a $50,000 position. And we're going to put that in our caller group. When would this be transacted? So options don't work in the after hours. Okay. And so the idea here, Gazelle, is that we're not actually looking to trade in the after hours. This idea of this class, when we first designed it, before Schwab announced that they were opening trading for a lot of stocks in the after hours, is like, what does the person do who has a full-time job and you've got kids and you've got to get them to ballet or hockey or soccer or whatever, and the only time you have to look at this stuff is after the kids are in bed or you're done your day and done your dinner and it's 8 or 9 o'clock at night. And so we're looking at, here's what's happened in the markets today or over the last week or over the last month, and how can we build and manage a portfolio by placing orders. And these orders are not, the intention isn't for them to fill in the extended hours. when bid-ask spreads can be wide. And with this one, options can't be traded in the after hours. So these will fill the next trading day. And that's what happened with the last 3 that we put on. Yeah, my superpowers are not that super, Wiley. Sorry, I wish it was otherwise. But yeah, I was saying today that I wanted to go to Harry Potter land because I want to, you know, pick up a new wand and ride a broom. Yeah. Okay. So that was Coca-Cola. And, you know, we don't have time to place another trade, but if you wanted to do another example trade, could we look at the Peppa at Dr. Pepper? We could, you know, and that's kind of that cup and handle type profile, breaking out. We're buying we would be buying protection over earnings, selling that covered call, or could we do that with KHC? I always think KFC, but KHC Kraft Heinz, you know, or could we be doing that, you know, with, and this is another one that's, you know, it's a company that sells tobacco, but it's considered a staple. And, you know, people that smoke, they consider those items as a staple. Yeah, so Gazelle is saying, so the order won't get canceled before the open tomorrow? No, the order, because we put them all in as day orders, they will become active when the market opens at 7:30. And then if they don't fill by the end of the day tomorrow, then they would expire. And so sometimes, like when there's movement in the market, when the market first opens, if the prices we've put in aren't a match with where the market is trading, then we may have to alter the prices a little bit. That's why I suggested we might want to, you know, go in and have a look. Okay. So we could look at Mondelez. Somebody else mentioned beer. So the Canadian Beer Company, TAP. Oh, this is Molson. Yeah, I used to drink Molson. My brother drank Molson Canadian. I drank Molson Golden. So, you know, this is considered a staple. Isn't that interesting? Molson Coors was founded in 1774. Now, I thought Molson was a Canadian company. So what do I know? But, you know, they make all kinds of, they make Corona. Who knew? Heineken. You know, they manufacture beer and other malt beverages. Molson Coors founded in 1774. So it's been around for a hot minute, hasn't it? But, you know, when we look at it now with this one, might we wait? Because what do we see? You know, I see that inverted head and shoulders, but no breakout. So we might just kind of want to wait. In any event, I thank you for joining me today. I hope this discussion has been helpful in looking at both new opportunities and then looking at ways to manage example trades that we put on back on March 7th. There will be lots more to come as we link arms and march bravely through, you know, what has been a most interesting and trying year thus far in the markets. I want to thank Mike Fairborn for joining me on this ride today. There is a survey link in the chat, and here's the deal with the survey. If you promise to fill it out, I promise to read each and every comment. There's just 2 questions. 1 was I hated it, 10 was I loved it, and then there's everything in between. And then you have the ability to let me know, are there topics you'd like me to cover in upcoming classes? All of that good stuff. I'm happy, you know, to be flexible with our content here. So yeah, so hit the like button, follow us in the land of X, and subscribe to the channel. Barb Armstrong CS, Mike Fairborn CS. Have a really awesome rest of your day, everyone. This is the end of our live webcast for today. Ciao.